Hey, welcome to Harvesting Income. Today we are going to look at an interesting topic. This is about comparing exchange traded funds versus investing in individual stocks. We had a previous video which was on stocks versus ETFs, and that had got good amount of comments and response. So today I thought I will make a video on this, but it's a little twist to the topic. Here I'm going to discuss about why ETFs, why not stocks, and I'm also going to talk about my own preference or choice, why I moved away from stocks. That's going to be a controversial and more interesting topic, and why I moved away from stocks and why into ETFs. Um, that's what we are going to discuss here, and I'll also talk about my previous experience, what I did with my previous stock picks, and so on. So let's get started. So before we go ahead, just want to tell you that this is only for knowledge purposes, and this is no investment recommendation. Consult with any investment advisor or tax expert before you make any investment decisions. Okay. So there are two, ways you can invest in equities. Like one is the stocks or buy shares of a company, or you can buy the exchange traded funds. Um, if you want to know the basics of each of these, you can watch one of my previous videos, which talks about stocks and ETFs. And but I'm just going to give you a quick summary. Basically, a stock represents a part ownership in a company, and the shareholder, you are the part owner of the company, and you have ownership of the assets and earnings of the company uh, in proportion to the number of shares you hold. And also, you have possibility of earning dividends if the company declares dividends, which is a small portion of the company's profits, or you also have the potential to get increase in capital that you invested, like basically increase in the price of the share. When the company's value goes up, your share price also goes up. So in that way, you're able to increase your value of the investment. So that's about the stocks. On the other hand, if you look at the exchange traded funds, these are also investing in the same equity markets or shares. However, it is a different vehicle. Keep in mind that an exchange traded fund doesn't mean that it's not stocks. It is also investing into certain set of stocks. However, there are different ETFs which manage basket of stocks. An exchange traded fund is basically a basket of stocks. One good example is an index ETF, which mirrors the broad index. For example, it could be an index which is mirroring the S&P 500, and that is called the S&P 500 Index Exchange Traded Fund. So instead of investing in one stock, if you buy one ETF, you're getting the entire basket of stocks. So like you see in the picture, when you buy one exchange traded fund, you're getting a combination of different stocks in one package. So basically, you are buying a diversified package rather than buying single stocks or individual companies. So that's the basic difference. And exchange traded funds also hold stocks, and those those stocks are basically individual stock, but they package it in a way that it's more easier for investors to buy the units of the fund and get exposure to multiple stocks at the same time. So that's the key difference here. And as we move ahead, we'll get to know pros and cons of each approach. And see, this is the big question that many people ask, like, um, can one pick stocks or pick ETF? So there are different options. There's no right or wrong answer for this. So I have put this, graphic here to just explain how it works. Let me just quickly explain to you. So here you have on one end the stock picker. I'm just using the pointer here to, show you what I'm explaining. So stock picker is the person who is picking individual companies or stocks. And it's not a random and easy way to just go, find the ticker symbol and just pick any stock. You don't just you just know the name of the company and you just type the name or ticker and then buy it. It doesn't work like that. There's a lot of research a lot of analysis, a lot of inputs that go into picking stocks. That is one end of the spectrum. On the extreme other end of the spectrum, we have passive investors. So these investors basically need something like a ready-made solution or something like a kind of a package, like an exchange traded fund, so that they don't have to go and pick stocks. They buy the entire market or the entire basket. So, I mean, if that is the better method, yes, of course, it's more diversified. It's more um, friendly for the beginners, and it's also more less volatile compared to individual stocks. And since you're buying ETF, you're buying a basket, not the entire, not single stocks, which is subject to certain risks. One company can have certain risks, but if you're buying a basket of companies, so the risk of one company or one industry is dramatically reduced. It's just like buying one portfolio. So having said that, these are the two teams that you can see. Like, so whether you go towards this side, the passive side, or you go towards the stock picking side, active side, it's completely your decision. So people can be anywhere in the spectrum. A person who is just investing in stocks, individual stocks only, would be on the left side of the spectrum. So on the left side, you see here, they would be here. I just put a mark there. And someone who is a pure index investor who only picks the ETF will be here. Like, and of course, it does not mean that if you pick stocks, you cannot pick ETFs. You can do both as well. And there would be some people who would be more on the stock picking side, but they would also have other types of funds. And there would be some people who are a little bit on the right, but not 100% passive, but they have other funds. And so there are people who are in the middle of the road, like some of them would be in the middle, and they would be hybrid investors. Like they would be like a mix of, stock plus index, or they may have different types of funds, different types of instruments, and that comes into the hybrid category. So where do I fall? Personally, I would fall more on the passive side, but I would be somewhere. I will put a green mark here. I would be somewhere here, like somewhere here. I don't know exactly where I would fall, but based on my observation of my portfolio, I would fall somewhere on the not extreme passive, but I would be on this side. And I'm almost getting to the more towards the right side, and I'm more aligned towards that. I'm not saying that's the best method or that's the way to go. Uh, each strategy is relevant for different types of people, different types of needs, different types of investors, different requirements. So all approaches or all strategies are valid. Let me repeat that again. Whether you are a dividend investor, growth investor, stock picker, index investor, or you're a hybrid investor, or you follow different approaches, every approach or strategy is equally valid. And what works or does not work, it all depends on the market condition, depends on your knowledge, expertise, and various other factors. So, yeah. So with that, we will move to the next area, and we'll see what next. Okay. So there are two different types of passive exchange traded fund. One is based on the index, like for example S&P 500 index, or you can have a diversified, which is not index based, but generally a diversified mix of stocks across different sectors, different companies, and so on. So these are two different types, and I'll explain one of them so you will get an idea. Uh, but before that, why move towards a passive index approach? Okay. Um, Try to guess an answer. So one thing that comes to mind is you want to simplify um, your process of buying a stock. Like basically, you don't want to be spending a lot of time researching and selecting stocks. And two, it's easier to buy a mix of things in a basket rather than trying to pick and choose individual investments. So these 2 points come to mind clear straight away. But there are other advantages as well. Yeah. So so this is the better way to answer that question. We want to minimize or eliminate SPOF. SPOF is basically single point of failure. I'll explain this here, and I'll also explain this in the next when we go to the, other slides in the next upcoming areas. So here, we are trying to minimize or eliminate single point of failure, that is SPOF. And this is actually Warren Buffett's two rules. I call it a single point of failure, which is much easier to understand. So let's say you invested in a basket or a fund, not one company. Let's say another scenario, you lost money and you're thrown out of the game because your stock or your company had a very bad, you know, a financial, fiasco. So think about what would happen. So if you have one of your stocks, like which is like about 5 to 10% of the portfolio, completely washed off, like then you're losing that 5% or 10% of your portfolio immediately. Let's say even if that stock falls by 50%, you will have that bigger impact. Like, if your stock is 10% of your portfolio, if it falls by half, like 50%, then your portfolio goes down by 5%. So that has a bigger hit on your portfolio. Whereas if you're invested in a fund and you have multiple funds in your portfolio, one stock taking a big hit is definitely going to hit a fund. It's going to get impacted by whatever that 5%, 10% number. So the thing is, you are actually investing in a fund which is diversified across different companies, different sectors. And each company has a very small, tiny fraction of that, uh, you know, um, specific company. So let me explain to you here. I will, you know, use a quick example so that you can understand. So let's say you invested in an index fund. So that will give you a better idea how this works. So let's say these are the stocks in the market, all stocks in the market. Let's say S&P, Russell, the entire stock market itself. Probably it has like 10,000 companies, 12,000, whatever number. And let's say part of it, a small part of it, 500 companies. I'm just putting a kind of a shade here. So this would be S&P 500 companies. So this would be S&P 500. So you imagine you invested only a small portion of your money in S&P. Like you also invested in another index, which is something else. There's another index which is the bottom something else, and you invested some money over there. So here, what happens is like you are investing in two different baskets. Let's say one company falls down by 10%. There's one company and it goes down by about 10%. So what happens in this case? Like there's a fall of 10%, and this company is in your portfolio. This company is about 10% of your portfolio. So your portfolio will go down by 10%, 1% basically, because this forms 10% of your portfolio and it fell down by 10%. So your portfolio has an impact of 1%, which is good. If you have a good diversified portfolio like this, it is good. But if you have a portfolio where this company forms 20%, then the whole portfolio is going to fall by 2%. But let's say you invested in this S&P and 500 ETF, and let's say one of the companies fell by 10%, the same scenario, same thing happened, the same company fell by 10%. But this company is only, percent of the portfolio. This company forms only 2% of the whole portfolio, entire portfolio. So what happens in this case? This company got like a big fall, and you basically are going to lose how much? So out of your 2%, you lost 10%. So you're basically losing only 0.2% of the entire portfolio. 0.2%. Okay, forgive my handwriting here. 0.2%. This will be your overall impact. Whereas in this case, your impact is 1%. So put it in a simple way, like if you are investing in single stocks and forming your own portfolio, a 10% fall in your stock, which is 10% of your portfolio, leads to 1% decline overall. Whereas a 10% fall in the same stock in a bigger portfolio where you are Your stock is only 2%. Your stock is only 10% of the portfolio, not 10% like in the earlier case. So in here, what is happening is your portfolio is down by point. So let's say your portfolio value is uh, $1,000. 1% fall is basically like it went down to $990. Whereas in this second case, if the portfolio is $1,000, it just went down by $2, 998. 1,000 to 998 in the second case. So your in this case is pretty less. So which option would you prefer? Like, would you prefer to, you know, go for the option where you can invest in a fund and lose 0.2%, or form your own portfolio, do all the hard work and lose 1%? The choice is obvious. However, I'm not saying that stock picking is bad or ETF is the best way to go. But I'm talking about a normal person who is already busy in a lot of things. They're busy in their profession, they're busy in taking care of their education or studies or professional pursuits, or they have to travel, they have to take care of the family, a lot of other responsibilities and a lot of other priorities that is occupying your time. And on top of that, you want to do your own stock research, study companies' financials, attend conference calls, make your own analysis, and then you also track industry and sector news developments, and you also find out what the finance minister or the central bank is going to do next. I mean, are you spending time on your core competence, or are you wasting your time just lose 1%, whereas you could have just invested in the index and maintained your principal and stayed safe? So that's the question. So that brings us to the answer that Warren Buffett gives us, that the rule number one is never lose money, and rule number two is remember rule number one. So there's just one rule. Like, the advice that he's trying to give is little simple, but you have to understand the logic here. You put in $100 in an investment. You don't want to lose that $100. You want to make more. Probably that 100 grows to $110, $120, or $150. It depends on the time, depends on the rate of return, and depends on how the investment grows. It's various factors. But you don't want to lose the money. You don't want to lose the original principle. Whether you make low returns, medium returns, or high returns, that's the second part of the strategy. But the main strategy is you don't lose money. That's the first thing. Because once you start losing money, you're out of the game. So once you start losing money, you're out of the game, or you will find a justification and say that, oh, these markets are manipulated and blah blah blah, and you will be out of the market. And probably you will say, I am safe investing in a savings account, and you will hardly beat inflation, and you're actually going backwards. So that's the principle that you need to understand, that you want to stay in the game and you want to protect your principal or your capital. That's the main objective. So I will go next and find out how this is going to work. But at the same time, you have to understand how the stocks work as well. So let's go to the next area. Okay. So whether you're investing in stocks or long or ETFs, ultimately you're investing in these. You're investing for the long term. So you recall back, like a lot of people talk about Warren Buffett and all these classic books and all that. Uh, there are a lot of theories you can go back, read, and all that. But one thing you have to remember is these were written back in 1940s, 50s, 60s, long, long time ago. So at that time, how were stocks traded? How people used to buy shares in a company? Just think about that. It's not the click of a button that they could buy stocks in those days. You have to actually go to a broker, do all the transactions to the broker. It takes a lot of time to receive the share certificates for each company that you buy a share in. And once you receive the certificates, then you will go back to your home or your bank or wherever you are and put it in a locker or in your closet. Just keep it there for several months or several years. Forget about it. And it was considered like a uh, kind of a safekeeping, like just like you safekeep your jewelry or cash or valuables. They used to keep the share certificate inside the closets or inside the safe, in their homes, or some people put it in lockers. That's how it was like. It was just like buying a house, not like flipping, you're buying a house to live for the long run, long term. Probably after 10 years, you may change your mind, but you're going to buy it for the long term. So here's what the guru says. Like, my favorite holding period is forever. But times have changed. Today, nobody is handling physical share certificates, and nobody is selling physical share certificates. Nobody is going to the stock exchange and doing, calling out and selling their, stocks. Like today, it's a different. It's all electronic. It's just a press of a button, and you buy, and press of a button, you sell it. But still, the concept of long-term investing doesn't change. However, there is one thing to keep in mind. The idea of holding period is forever worked into the 50s, 60s, 1940s, 30s, pretty good. But now, today, things have changed. Like, it is not feasible to hold something forever. What if it's not performing well? Are you going to get married to your stock? Are you going to get married to your fund? Not me. I'm not going to do that. Like, no matter which guru it says or what they preach, it's okay. Let them do that. But I'm not here to do that. It's my money. I want to protect my principal. I want to follow the rule number one, which works for me. So I want to take things with a pinch of salt or a grain of salt. You must take these things with a grain of salt and apply your own logic. And I agree with this. If this applies to an index ETF, if this saying that holding period is forever is for an S&P 500, I would 100% agree with that, and I would be happy to hold the index ETF as long as it is feasible, and as long as I don't need that money, as long as I'm not in a pressure, I'm going to hold it forever because I know that S&P 500 is not going to falter. Probably the single stocks or single companies might falter, but not the S&P 500 index. It can go down by 50%. I don't care. I can hold it forever. What about you? Now I got you thinking. Now you should start thinking in that direction. Do you want to invest in that so-called beautiful company, or someone gave you that and bet on that, or do you want to invest in the S&P 500, which has been there for like 100 years? Yeah, so you can make your own choice. I'm not trying to give any recommendation here. Okay, so the other aspect is when you're investing in stock, you're going to spend a lot of time on research and analysis. With exchange traded funds, you're going to spend less time. You think it's obvious, oh, okay, I can do research, I know the stocks. Have you done the quarterly result analysis? Have you read the conference call transcripts? If you ask me, like about 12 years ago or 13 years ago, I used to do all this. Even I was doing this, even since last 2 or 3 years, I've been doing this. Probably I've reduced doing this for the last couple of years because I've already liquidated some of my stocks. Only one stock left in my portfolio. So have you done the quarterly results analysis? Do you read the conference call transcripts? Do you listen to the conference calls, or do you follow the company's news? Do you follow the industry developments and see what's happening in that industry? Do you know how much revenue the company is generating, how much profit margin, what is the return on capital, return on equity? You know where I'm going now. So I'm not expecting you to know every aspect of the financials. I'm not expecting you to be a CPA or that level. But a lot of people who do research on stocks, even though they are not experts in that area, they still do all the work that we are talking about here. Like they still do all the analysis we are talking about. Why do they do that? Because obviously, you need to track the company every quarter, see what's happening. That's how you'll know what's happening. Otherwise, suddenly one day the stock falls by 20% and you're wondering what's going on. It's not the way it works. Like, so if you are investing in a stock, you're investing in the company, you're investing in the business. People call themselves value investors and they uh, pick stocks, copying some guru, but you copy the guru, but not his methods. Unfortunately, you cannot replicate guru's methods. It's the problem. Anyway, so if you're not able to do all of this, then you're just trying to compromise. Or at least if you're able to do 70% of what is mentioned here, like 70%, I would still say fine. Yeah, you've done some homework, you've done some research. That's fine. Like you can still, you can still do well. Like there's nothing wrong, and nobody's perfect. But if you're not even done 50% of what is being said here, then obviously you are compromising. Like you're just trying to, um, you're just trying to, justify yourself and then trying to gamble. Okay, so there's nothing wrong in gambling and speculation, but the thing is, it has to be more informed decision making rather than just blindly, betting on something. Okay, anyway, let's move to the next area now. Okay, this is another big decision making that you have to do when you select stocks. And even if you select funds, you have to do a little bit of this. However, the amount of research that you do on this area would be pretty less when you do the when you pick funds. And there's a reason why, because you're not going to be very active. You're going to be on the passive side. So you can take a back seat, you can relax, you can probably not even watch stock prices for a week. Nothing is going to happen. But if you're buying stocks, you will always be tempted and you will be forced to do that. And you have to do your research as well. And there are different aspects of it. Well, there are four of them which I listed here, but there are more than this actually. But these are the four key things which I wanted to cover. One is when to buy the stock, like, and you have to do your own stock valuation as well. Like, did you really calculate the value of the company, the real value of the company, not the stock price, but the real value of the company, and then compare it with the stock price to see if it is cheap, undervalued, overvalued. Did you do that exercise? Like, if you don't do that exercise, then you will not know when to buy. So when to buy is not just when the stock price is falling, but it's just doing all the research and the back end work. When to sell is similarly. If you've done all the homework, then the first two questions are answered: when to buy and when to sell. So when to sell will be like when you see a time when the company is really overvalued, or probably it is valued at a higher price than its actual worth, based on your research and your own homework and your own analysis. That's when you sell. So that's what typically value investors say. You buy at a price below the you know value of the company, and they call it margin of safety. Let's say you buy a company, $1 company at 70 cents. You're buying at a discount, like you're buying at a margin of safety. You're basically buying on a bargain. And when you sell, sometimes you find that the same company after a few years is worth $2, but it's trading in the market for $3, like, and you quickly find the opportunity and quickly sell it off, like, because you find that the value of the company is only $2, but you can sell it for $3. I mean, this is just an example. In real life, it can be different numbers. And the third question is similar to the first one. You have invested in a company or a stock, and at some point you see that it's falling, or there is some bad news or something happening in the company which is not favorable. Prices are falling down. Now, you were a long-term investor, you had faith in the company, the products, and all that. Now, now you're asking the question, can I accumulate the company or the stock on dips? This is another decision making that you have to do, ongoing decision making. And when you do that, finally you want to sell or you don't know what to do. And then you're asking a question. Is my investing thesis working? Is my investment idea or philosophy working or not? And that's okay. No investment strategy is perfect. And stock picking is also a valid strategy. It works. It works for some people and they are really good at it. I'm not trying to use this video to, bring down anybody's value here. There are good professional stock pickers and professionals who are doing well. However, you as a normal person, are you capable enough to beat professionals? Are you capable enough to beat the S&P 500 over the last 10 years? It's the question you have to ask yourself. And if you're not able to get a strong answer with the of evidence and numbers, you have to question your own thinking. Like, you cannot just go by guesswork. You have to do your own analysis. And if you're not good enough, I would say, go for a simpler option. And I'm not asking anybody to quit picking stocks, but in the future, you may want to change your strategies according to your capabilities. Okay. Moving ahead, there's another issue: volatility with stocks. Stocks are more volatile than ETFs. And generally speaking, single stocks are more volatile than the index. Index is a basket of stocks. So what happens is a bunch of stocks go up, some of them go down, some of them are flat. It all gets balanced out. So net, it can go up a little bit, go down a little bit. Compared to the individual stock swings, the swings in the index is pretty low. But however, there can be exceptions. You can also find exceptions like a Microsoft stock or something which can be a low um, volatility stock or a stock which doesn't go up or down much, except on a certain days like earnings and all that. However, or if you see overall, the index is a more smoothened basket of stocks that moves a little bit in a orderly fashion, moderate volatility, I would say. So the question that we have to ask is, you can see the on the right side, do you have a higher chance of losing your capital with indices or with stocks? Obviously, with the stocks, you have a higher chance of losing your capital. With blue chip stocks, the probability of losing your capital is pretty less. With blue chip stocks or established companies which have been there for a long time. But of course, you hear also stories about the companies such as General Electric, Nortel. Once upon a time, these were the blue chips. These were the leaders in the index. Where are they today? That's another question that you need to, ponder because you're not investing for next 2 years or next 3 years. After next 2 years, things will change, or a next big event may come. There could be global warming, or economy goes down, or there could be a new kind of a health issue or something coming up. We never know. Like, but is your portfolio good enough to withstand any kind of uh, changes in the economy, in global geopolitical landscape, or even small things like increase in the inflation rate, or unemployment rate, or economic growth, etc., etc. Can go on. So, is your portfolio robust enough to tackle all that? I would say if it is more based on the index, you will still have the volatility, but you can still stomach or um, digest that kind of volatility, which is easier for you. And you don't have to sell, buy. You don't have to panic in that moment. Like you can stay invested, you can stay calm. Probably you can buy on dips, or you can accumulate at lower prices if the opportunity is good enough. Or if you don't want to do that, you want to wait it out, that's fine too. So you have all the options open for you. But in the case of stocks, you have to be very careful. You have to book your profits. And if you're not doing well, if the company is not doing well, better book your losses and get away. Otherwise, you're going to burn your fingers. Okay. Anyway, you got the message now. So if you're able to tackle with that volatility, stocks are for you. That's your friend. You can even go for sector ETFs if you want. Um, if you're not able to do that, then you need to really, go for something which is better, like a better option, a safer option. And there's nothing wrong. Like if you're not able to do that, then better go for a safer option. You should not risk your capital. That's the main thing here. Okay, now we'll go to the next. Like now, the index investing as a way of investing is established in terms of ability to reduce your overall volatility. And what are these indices like? Indices are basically like a parameter of the market. Like it could be like S&P 500, which is covering almost 80% of stocks in the market, and they reflect the overall movement of a basket of stocks. But there could be other indices like Nasdaq 100, or even you have the Russell 2000 index, which covers a different segment of the market. Like Nasdaq covers more of the and tech-oriented companies, and Russell 2000 is more of mid cap, small cap, and these provide a indication of the overall market moves, like how the market is doing. It's going positive or negative. It gives you just a general idea. And some of the indices are also used as a benchmark performance. So when there is a fund which is delivering certain amount of returns, fund is delivering 10% return in a year. Then they compare that with the index. The index is delivering 30% returns. Then the fund is underperforming the index. So the index is used like a benchmark to see how well the fund is performing. And also there are exchange traded fund and other products which are used to create index funds. So here you can see different types of products can be created. Like it could be index fund, it could be an index what call ETF. We'll see different types of products as we move ahead. So these are different things that can happen, and different kind of products that can be created out of the index. So this gives you a summary of what are the different indices, and then we can look at S&P 500 index. So what is the S&P 500 index? It is the barometer of the US market, covers about 80% of the entire value of all the stocks or market capitalization. approximately 500 companies are part of the index. And there is a formula like each company has a certain weight or certain, a percentage in the index. So depending on that, the value of the index goes up or down. Like because a lot of companies share prices move up, sometimes moves down. Like so, everything is put into a formula, into a kind of methodology, and then that weighted average of the entire portfolio will decide whether the index moves up or moves down. So each stock's weight in the index is proportionate to its market cap. Market cap is basically the value of the company, number of shares multiplied by the share price. So that would decide that individual companies go up or down, and the overall index also can move up or down depending on how the total moves. And finally, there's also another aspect. This is very, very important. Like because for an investor like you who are looking at index ETF, if you're interested in the investing in the index, for example, you want to make sure what you are investing in. You are not going to be investing in some random 500 companies. And every quarter, the index is actually changed. And the index is not a random selection of 500 companies. They select the top 500 companies with a certain criteria in terms of market capitalization, financials, and so on. So every quarter, usually March, June, September, and December, they make changes to the index. Some companies get added to the index. Some companies are removed from the index. So there's going to be a kind of plus and minus companies getting added and removed. So there's a dating of the index that takes place every quarter. So that's called rebalancing. The portfolio is rebalanced every quarter. So which means like if you have your own portfolio, you will also be doing that. Like at some point, some stocks perform well, some do not. So you will be making changes to your portfolio. And with the index, the same thing is happening. But in this case, why it is more simpler is because you don't have to worry about that. The index committee or the index team is doing the work for you. They select the stocks to be added to the index and they remove certain stocks. So, like I said in the previous example, some of the companies like General Electric were dominant players in the index 20 years ago. Today, the dominant players are Apple and Google's of the world. It's completely changed. So, 20 years from now, the index would look completely different. Probably you might see a different set of companies. Probably you might not see all these big names that you see today, right? So you can change you can say that, oh, I will change my portfolio. I will do all that. Are you willing to do that research? Are you willing to follow each company, each industry, each sector every quarter? You follow the results. You see how the company is performing. What are the areas they do well, they don't do well, and you make your right decisions and do all that. I think that's almost like a full-time job. Like research analysts and fund managers are already doing that. So you can invest in a fund where the research is being done by professionals, or you can try to do it yourself. It's your choice. Professional investors can do it themselves. Professional traders have other strategies. They do trading. However, for you, you are basically involved in your profession, in your main occupation. Your focus should be on investing in a basket of stocks and focusing on that basket. Like you can invest in different baskets. So that helps you save a lot of time, effort, energy, money, etc. So, so you can invest in the S&P index, which covers the entire market almost. So you don't have to go beyond this, but of course there are various options. Okay, like I mentioned in the previous, index is not static; it changes quarterly, and newer companies with greater financial strength will be included. So, as I mentioned before, it's the same thing. 20 years ago, these companies were not significant, but now they're becoming bigger and major part of the index. And some companies can get excluded due to changes in financial performance. And this provides passive investors with a self-cleansing mechanism, which is what I mentioned here. That if you are able to invest in the index, you are able to invest in something dates automatically. It's just like you download the software. Let's say you download a Zoom software or any other software like you have like Microsoft Office software or anything. Once you install it and once you keep it and use it, it keeps updating. You run the update once in a while and it's automatically updated. Even the apps on your phone gets automatically updated. The same way, index automatically gets updated and you're automatically updated on your portfolio is fine, right? Then why do you waste time picking companies, stocks, looking at what's happening? Are you really, investing your time into something really useful, or just wasting your time into trying to become the next stock picking guru. So that's the choice you can make for yourself. Okay. So when you decide to invest in index ETFs, there are various options available. And it's not necessarily just the index ETFs. They can also be non-index but diversified funds as well. So we'll come to that later stage. But first is pure index ETFs. These are the ones which is more popular among the pure passive investors. So one example is like a SPY, that's a S&P 500 ETF trust from State Street Global Advisors. This is one index ETF and pretty popular among passive investors. And there's the second one, IVV, which is almost similar, same kind of design, same index. So when you look at these two funds, the design will be similar because it follows the S&P 500 index. So you have, let's say you have S&P 500 index on one side, and let's say you have the exchange traded fund on the other side. The design or composition of stocks will be exactly similar. There may be minor changes because of the changes in the index, or there may be minor changes because of fees or any expenses. Other than that, the stocks holdings would be exactly the same because they mirror the index. And in terms of performance too, they would be somewhat similar, but there may be minor changes because of the fees, expenses. So having said that, there's also other indices that you have to focus on. That's where we come to the third one, Vanguard Russell 2000 ETFs. This ETF focuses on the Russell 2000 index. So if you are focused on the mid cap companies, you can go for this ETF. It can provide you exposure to the mid cap companies or mid sized companies which have a future growth potential. And again, instead of investing in those companies, single companies or single stocks, you're investing in the basket. So even if those mid cap companies fail or something happens, you're not impacted so much. And if there is a fund which holds 2,000 companies, even if there's a 10 or 20 companies which are not good enough in that portfolio, it's not going to it's not going to falter the portfolio or going to turn the board upside down. It's not going to happen. Like it's going to have an impact, sure, but it's not going to topple your portfolio, and you don't have to worry about selling, buying, panicking about that. You just get focused on your work and your main drivers of what your profession or your occupation is. Leave the portfolio aside, and when the time comes, you can invest a little more and grow your portfolio gradually over time. And that helps you have the long term patient mindset, grow your portfolio rather than trying to jump from one to the other. So you are trying to be focused. And this is where the difference is, like you are able to different baskets instead of different stocks. So you are not worried if one small component of one basket is going to get affected. So you're still smartly able to diversify and withstand any kind of volatility. The last category is like a packaged funds or asset allocation fund. I use the word package. It sounds more easier to understand. Basically, these are XEQT, VEQT. These funds basically invest a part of the money in your equities, part of the money in fixed income, and a little bit in gold or something. So they basically try to allocate across different assets. That's the concept, and that's a separate video, that separate topic that you can get into. So this is another option that you can look at. So from here, I can see even if you are a pure passive index investor, you have three options. One is you can go for the pure index like a S&P 500, Russell, Nasdaq 100. That's one option. Or you can go for the packaged options like set allocation funds. And apart from this, we have other options also. If you are looking for income or some kind of a different strategy, so it's not as if you are going to be just running out of options. You have multiple options because the market has evolved so much. And let's look at the next interesting area, which is the covered call ETF. A lot of people like to bash on the covered call ETF, saying that these are actually scams, and they actually circle back and give you your own money and try to show you a high yield and so on. I would say any fund or any product, any investment, any kind of financial instrument will have its own pros and cons. It's important for you to analyze and see what works best for you, and also understand its positives and drawbacks as well. So get a clear picture, and you should also be aware of the risks of a product so that you can avoid those risky situations. So if you're not aware of the risks, if you're not done your homework, not done your research, and just pick blindly any fund comes on the internet or YouTube, then it's not a good decision. Even from this video, the companies or funds or options that we are discussing, this is only to give you a base or kind of idea of how things work. These are not investment recommendations. Bear in mind, this is not a financial advice. So you have to do your own research and see what works for you, and then pick what works. And sometimes I share my experience too, but that's just my personal experience. It doesn't mean that I am the one who is going to teach you the success formula or anything. Okay, so I'm trying my best to give you the correct information so that you can get a more objective and broad idea. However, I'm not the your success guru is going to give you that secret formula to get rich in X months or X weeks. That's not the objective. So okay, quickly going through this. These are the covered call ETFs. They follow a derivative, instrument called options or call options to generate income. How they do that, basically, that's a very big topic. But there are two parts of it. You understand the index ETF. These ETFs are actually more or less index ETFs. So they invest in the same product, same underlying asset. Example, IVVW, the iShares S&P 500 buy rate ETF. This is from iShares or BlackRock. They invest in the S&P 500 stocks. So that's the point number one. So that's the first half of it that you should understand. Second part of it is on the same index, they write covered calls. Basically, they also sell calls on the index. Basically, you can imagine like they sell uh, uh, calls at a higher price than the index, and they would be generating premium out of that. And different funds follow different strategies. I'm just talking about IVVW. So on one part, the portfolio is just like an index ETF. So whenever you're investing in these funds, it's not like you're making any kind of covered call or some speculation. It's basically you're investing in the same index, and you have the same risk. Index goes up, index goes down. You have the same kind of risk, but you are able to do an additional component of income generation. You're not doing it. The fund managers are able to sell calls on the index, which will generate regular income. In other words, I can say that covered calls are a trading component of the index, and that trading component is going to give you that extra income. So the only time this strategy may not work is if the market is going up steadily, for a period of several months. The covered call funds will underperform the index. You can imagine the same example between stocks and ETFs. Stocks are very volatile. They can give great amount of returns as well. So that's a good positive. Whereas ETFs, they are not that volatile. So obviously the returns are moderate. The same way, when indices can go up dramatically and give you linked returns, whereas covered calls will give you slightly lower returns because covered call underperforms index when the market is very positive or very bullish. However, in a flat or down trending markets, covered call ETFs outperform the index. How do they do that? We will discuss that in the future videos. But these are the three funds. OILG is another interesting fund from the Global X Covered Call um, Growth Fund from the Global X ETFs, and this is similar to the first one. The only thing is Global X writes covered calls at the current market level. They don't write it above the current market. So basically, they are trying to generate more income, less capital appreciation. And SPYI is able to, generate a decent amount of income and capital appreciation. Plus, they are also able to capture a little bit of upside. If you want to know more about SPYI, you can watch one of my previous videos where I have talked about this fund and its unique strategy. They have some unique strategy compared to the other two funds. So that's something you need to watch in one of my previous videos. I'm not going to go into detail here, but if you want to know more, you can always watch that video. And similarly, for the first one, IVVW, I have done a video which is about this so-called boring ETF. I called it a boring ETF. But what happened is it turns out that that video had a lot of views and a lot of response. So you may want to watch that as well, like because it's boring ETF, but it delivers good returns. Boring or not, it's not what we care about. We care about the total returns has to be good and it has to be safe. Okay, let's move to the next one. Why move towards the passive diversified fund approach? The second approach I talked about is the diversified fund approach. First one is the index approach. The second one would be the diversified fund approach. Diversified fund approach is a little different. Instead of following an index or a kind of a formula, you are actually relying on the fund manager. They design their own portfolio because they know the market, they know the company's sectors. They customize the portfolio and pair it in a certain way. And for you, for me, or you as an investor, we have to look at the portfolio, look at the methodology, look at the investing strategy, what is the cost, what is the expense ratio, and all that, and decide whether this fund is for you or no. I have picked some diversified funds too because I don't want to rely 100% just on the index based ETFs. So I have full of diversified funds. And you may want to pick that, like I'm not recommending, but you may want to look at these also because these could be similar to index or maybe not similar to index. It depends on the type of fund you're looking at. And let's see some examples or some, idea of how this works. Most of the features are similar to the previous one, index one, but the thing is the portfolio is more customized. It's not index based. And that's what the second bullet point is. Instead of following an index, the fund has its own methodology or investment criteria. So the fund manager decides on certain criteria. They may stocks which are in certain growth, high growth sectors, or they may pick stocks which is based on certain financial parameters, returns or growth, or financial strength, profitability, or companies which have lower amount of debt, or companies which have a lower volatility, or companies which pay a higher dividend, or companies which have a dividend growth track record. There can be a lot of parameters which go into that. It changes from fund to fund. So I cannot say that this is the exact formula for every fund. Every fund has its own methodology. So if I look at this example, non-index based funds, one of the examples that comes to mind is the JP Morgan S&P 500 Premium ETF. They use S&P 500 as a starting point, but they don't exactly use the same composition like S&P 500. Out of the S&P 500, they do some more research and data gathering, and they come up with their own portfolio of select stocks which are part of the S&P 500. So out of the big S&P 500, they narrow down and bring it to a smaller number, and only in those stocks they focus on, and they would be investing in those stocks. And covered calls would be written on those on the entire portfolio. And the way they write calls, the strategies, this can differ. And the second example is YMAX, which is the Yield Max fund, and they hold a bunch of funds. There are different funds within their portfolio. For each company, they have one fund where they hold that company or stock and they write covered call ETF. And they packaged all these funds into YMAX, which is the bigger fund. And so basically, they packaged their own funds into a basket called YMAX. And that is a diversified portfolio, and it's not based on any index. They have picked certain specific stocks that they like to hold and write covered calls. And for more details, you can go to their website, look at it. And once again, these are not recommendations. These are just examples I'm sharing. Okay. What are the takeaways now? Like we have seen two ideas. One is the investing in the index. The other one would be the diversified portfolio. What do we understand from here? Like there are different approaches that you can take, and you can take any of these approaches or mix and match any of these three. Like it's up to you. Like one is the index tracker. Index tracker is just following the index, it's mirroring the index. Funds such as SPY, IVV, these are just tracking the index. So the first one, the examples are SPY, IVV, BTWO, etc. And they follow the respective index. SPY and IVV are following the S&P 500. VTWO is following the Russell index. And the objective is to track the performance of the index. They are not trying to beat the index. They are trying to just track the performance. And the style is passive index based. Simple. Second type of fund is index covered call ETFs. So basically, they AVV, W, XYLG, etc. They again track the respective index. The underlying asset or the base investment goes into the index. However, the objective is to replicate the index, plus also derive extra income from the covered calls. So again, here the objective can be different from fund to fund. Some funds focus on the replication of index number one, capital appreciation, and second would be income. Some funds would income first, and then the second would be the capital appreciation. So, but overall, the objective will be a mix of these two. And this is again a passive income index, and it's a mix of income and index investing. Like, so they are trying to be a little bit income oriented rather than just being passive. And the third fund, which is similar to the second, it's a non-index, but it's a diversified call ETFs like JP, YMAX, etc. Um, they have their own portfolio, but they would use some broad comparable index as the underlying to compare, but they have their own portfolio, own technology. So underlying index that is used is only for the comparisons, and the objective is to have a diversified portfolio and write covered calls to make income. The second and third category is more or less similar. Passive income and index. Again, style is passive income plus index. The only difference is the second one is index based. The third one is more of a diversified fund. Okay, these are just examples or some fund categories used for illustration. Okay, this is not to be taken as investment advice, and also these are not the exhaustive list of funds. There are many other kinds of funds which are not fitting into these categories or these boxes. So there are many to choose from, and you can do further research on this. And in future videos, I'm also going to cover some of them. But um, these are the broad ones which you can stick to when you're starting new, or when you're starting your investment, or if you want to allocate a big portion of your money. These are some of the things to look at, assuming you are more inclined towards the passive or index ETF style of investing. So these are the funds you can use as a starting point. I'm not saying these are recommendations. And you can look at other funds in the same category. You can do more research and find other funds in the same category and see what suits your requirements, and then make your own choices. And now, but by now you are convinced that picking index ETFs is better than picking stocks. And amount of time, effort, and money that you're saving here is tremendous. Like, it's going to help you build wealth in the long run. And with that, like, let me go to the next area to share my own observations as we are coming to the close to the end of it. And if you have any questions, any ideas, or if you have a different experience, like you have uh, different ideas, or you don't agree with me, or you have a different point of view, feel free to comment below. I like to hear your views, especially if you are thinking differently or you have a opposite point of view. Okay with that. We can have a fair amount of discussion on this. This is my observation. The slide is not um, uh, you know, this is my personal views. My observation of stocks versus index ETFs. And some of them may be true in general, but some of them are just my personal views. So I have just listed random points that I, like or dislike. This is my thought. It could be completely incorrect. Let me, if you have a different view. Stocks and index ETFs, I compared these two. Stocks can go to zero or low levels, eroding your capital dramatically. It can be probably blue chip stocks are exceptions. Once upon a time, like 12 years ago, I wrote a book on how to invest in blue chip stocks to create wealth. And now I'm, trying to justify that the blue chip stocks still have that capability. However, even with blue chip stocks, you can still, chances of going wrong is pretty high. But index ETF, you have you have a minimum chance of going wrong as such, because index will not go to zero or close to it, but it can erode capital as well. So basically, it's like you're not going to collapse or fail. The whole building is not going to collapse. That's the underlying message that I'm giving. You're still safe. That's the point number one. So about both stocks and index ETF. Second point about stocks and index ETF is one company, one sector, one bad decision can bring down a stock. Have we already discussed that? One issue with the stock or a few stocks, it doesn't topple an index ETF. Second point. Second point, I think most of you will agree that there's no debate there. However, some people will still debate and say that, oh, I picked up this company because this company has a strong economic moat, and I bought it at a value which is an attractive value below the company's intrinsic value and at a higher margin of safety. Okay, if you're a professional, you're a value investor, you're a Warren Buffett fan, good luck to you. Go ahead and do that. But if you're not inclined enough to do research on the company, follow the news, follow the company's conference calls, study the financial statement, balance sheet, income statement, cash flow statement, and also do your own analysis of margins, financial ratios, then you will have to, rethink about your own strategy. You don't have to agree with me, but you rethink about your own strategy and then see what are the other options that can work for you. Okay, the third point is you have to get out or sell a losing stock, sell losing stock. And in the index ETF, you may sell or hold a losing ETF, your call. Okay, this is an interesting, a lot of people may not agree with it. Um, I'm talking only about index ETFs. I'm not talking about all ETFs. So every ETF has its own pros and cons. The reason index ETFs are okay is because you can still hold on to a losing one. You may have a notional capital loss, but you have the time to recover. Similarly, you can hold on to a blue chip stock and you have time to recover. Yes, I agree with that. I agree with your counter argument. However, your capital is going to get stuck. Are you getting sufficient amount of dividends or income to support that? Or will your main income or occupation or your income from other sources can support this decision to hold the stock forever? Because your guru said that you can hold a stock forever. So will you be okay to finance your own portfolio and keep putting in money in a bad market? Let's say you had a bad market like 2008, 9, and your stocks fell by 50%. And do you have the stomach to withstand that kind of volatility? And after your stocks fell by 50% and the economy is going down and there's a lot of unemployment, and a lot of news about companies laying off people, and you would go out and bet your farm and buy the stock and prove yourself. If you can do that, wonderful. Go ahead and do that. I want to see your success story. But unfortunately, it doesn't work like that. You have to be very practical. You need to plan your other aspects of your finances. And everybody has life going for themselves. Like nothing is perfect. So, sometimes even the ETF may not work. Sometimes the ETF can make you lose capital. And you may have to withdraw your funds or you may have to sell sometimes. Probably you need funds for your emergencies, or your vehicle broke down, or your refrigerator broke down, or your mortgage rate has gone up, or some of your expenses have gone up, or probably you had to pay higher rents or move to a new place. Whatever the reasons might be, life happens. So one simple answer I want to give you at the bottom is to avoid or minimize the single point of failure. It is the Fed's rule number one. So I am rewording it as a single point of failure, but rule number one says don't lose your money or don't lose your principal or capital. So once you lose the principal or capital, what happens is you're out of the game. So once you're out of the game, you will not come back. You will completely justify your actions, and you will say this market is all manipulated, and I'm not coming back. So before closing the session here, I would like to say that before you make any extreme decisions, look at all the different options. I'm not saying that you should not have stocks. I still have one last stock in my portfolio, which I'm keeping, which is a very small portion of my portfolio. And at some point, I might sell and get come out of it. And I am more into index ETFs and other types of covered call ETFs and other funds. I'm not saying you should go for this option or that option. You can always have a mix of different products or different types of investments in your portfolio, including stocks, index ETFs, or even growth ETFs and other types of ETFs and funds, and also even REITs and other products. But you need to be diversified. You know what you're investing in, do your research so that you can create sustainable long term wealth. That's the whole objective of harvesting income, to make you geared up and teach you how you can make long term wealth, which is sustainable, doable, and also easier to maintain over the long. That with that, I would like to close this session, and I thank everyone for having patience to watch till the end. If you have any questions, feedback, please drop them below. Thanks a lot. Have a great day and wish you all a happy new year once again.